Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 15th of October. I'm Daniel Lam, your host for the podcast. Gold had been extremely strong throughout this year, especially over the last 2 months, when it had been rising pretty much regardless of market conditions. When it was risk on, it was up. When it was risk off, such as what we saw during the re-escalation of the trade war at the end of last week, it went higher. So the pace of the rally is suggesting changes in the buying forces behind. So gold's rise was, at the start, due to fundamental factors, i.e. the official sector buying, and then the macro drivers, so the return of the real yield correlation, and to structural factors, i.e. the Fed independence concerns. The dips have been very mild throughout this year, especially in the last 2 months, so this is a strong indication of demand. The record central bank buying started to slow this year relative to the record levels of the previous 2 years. So in the first half of this year, we saw $40 billion of buying versus $84 billion in 2024. But the ETP, i.e. the exchange-traded products, the investors have taken up the baton with a whopping $67 billion of buying year to date versus only $1.1 billion in 2024. New buyers, including family offices, have started to accumulate at its fastest pace since 2022. Now, also very important to note that there has not been a noticeable major seller of gold. That is what has been driving the relentless rise from 3,000 to above 4,000. So, for example, when gold breached 2,000 for the first time in 2020 due to the pandemic concerns, it was driven by record ETP demand. And in 2008, when gold first breached the 1,000 level, following the subprime crisis and then the global financial crisis, the official sector was actually a net seller. This ongoing structural shift in gold's role within the portfolio as a safe haven and diversifier is driven by heightened geopolitical tensions, expectations of further rate cuts, tariff uncertainties, and Fed independence concerns. So the last point was the basis of this debasement trade, i.e. investors diversifying from fiat currencies strained by inflation and fiscal or regulatory overreaches. Both gold and Bitcoin are actually key representatives for this debasement trade. But gold has been a superior hedge asset to Bitcoin during times of global risk-off. So Bitcoin has been significantly more exposed to risk aversion. It had not been able to stand up to times of market stress in spreads and in volatility. But gold had proven itself to be a more reliable hedge in times of market distress. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.